Hello and welcome to this special budget event just for you lovely Telegraph subscribers. My name is Sam Brobeck, I'm the Telegraph's Money Advice Editor. Now last week Labour delivered its first budget for 14 years and Rachel Reeves announced the biggest tax rises for a generation. We're here to discuss what all of this means for your money. And I'm joined today by Paul Lewis, the legendary presenter of BBC Radio 4's Money Box, and Chris Boulay, our resident tax guru from accountants Blick Rothenberg. But before we get started, I've got a little bit of housekeeping. If you want to make the video full screen, there's a button in the bottom right-hand corner of your screen. Just click that and it will get bigger. To ask us a question, and we hope you get loads of questions, we've had some through already, just type it in the box beneath the video and it will pop up on my tablet as long as it isn't rude. Before we get to your questions, I'm going to ask our experts their first impressions, what they made of Rachel Reeves' first budget. There was a huge amount of speculation about, 100 days or so. Was it as radical as many people feared, Paul?
I think it was radical, but I think there are the more interesting things were what she didn't do. You know, she didn't do the things that people like you and me, Chris, have been talking about for 3 months. She didn't do anything with the pension lump sum, for example, so that you can take that out. You can put as much as you like, up to 60,000 a year, into a pension with no lifetime allowance. She didn't bring that back. So there's lots of things she didn't do. And with inheritance tax, she didn't have any limits on lifetime gifts, no limit on how much you can leave to your spouse or your civil partner. So those are all positive things that people in a way have overlooked, the things she didn't do. I think she was quite radical in bringing pensions into inheritance tax, and I know that's a very controversial subject for Telegraph listeners. Well, we'll see what people ask later. But I think that was for me that was a positive thing as well, because I think pensions are for you to spend in your life, not to leave to your children. But I'm sure that would be a very, very unpopular view. But I think the capital gains tax, that wasn't that radical. She raised it a bit. But remember when Nigel Lawson introduced this in 1988, I think, capital gains were charged at the same rate as income tax. As part of his great simplification. Now, of course, capital gains, even now, are charged less. And there was no change to the capital gains tax on a second home that you might have that you sell, which is when it often comes up and bites people. So I think she did a lot of interesting things, but I don't think it was that radical, no. I think it could have been, for me, it could have been far more radical.
Okay, we got away with it then, or not? Chris?
Yes, there were a few things that weren't a great surprise. Some of the increase in the CGT rates. Okay, they'd largely been muted for a few months, so they were anticipated. Some of the things that I found quite sort of eyebrow raising and quite a surprise was the inherited pension funds. For anybody who's been working quite hard throughout their career and planning and had an expectation on, okay, this is what's going to happen. Rachel's made some quite wide sweeping changes which will affect not only this generation but their beneficiaries. BPR, APR, that was quite a...
So that's business property relief.
Business property and agricultural property relief.
Yeah, Jeremy Clarkson's furious, I hear.
Yes, certainly anybody up in Cheltenham, Gloucestershire direction and then all the farming communities were probably sitting there leaning into their radios thinking, wow, okay, we didn't see this coming. And quickly probably putting a value on their farms and thinking, well, trying to quantify how is this going to cost us? And do we need to start planning sooner rather than later? And then for me, the other bit is, I do tend to feel this is a form of wealth tax, because those that are mostly affected by this budget are those that have assets. Now, they might, and the passing of those assets, the way we tax those assets, it is, to me, a disguised form of wealth tax.
Can I just say on both those things, though, agricultural property relief and also pensions being subject to inheritance tax, it's not that these exemptions have been there forever. I mean, before 1984, agricultural land didn't have any relief from death duties, and it was only 50% then, and then it went up to 100% in 1992, 93, I think. So that's okay, that's been there 30 years, but it's not that long. And hiding your pensions from inheritance tax has only been around since 2015, I think. So they're not ancient old reliefs that we all expected that have gone. These are fairly new things that people have taken advantage of or expected to take advantage of that are now being taken back. And that's always the way with tax. A chancellor can always undo something that another chancellor might have given you.
No, I suppose particularly on the pensions move, and we're going to get on to that next. I think that is probably the number one topic for people listening. You would expect a Labour Chancellor to do probably what Rachel Reeves has done. It doesn't mean it's not painful for people who have saved that money and then they spend a lot of time thinking about how to protect it. Should we go straight into that then? Because I think that is, for us, that's by far we have the most letters and we're getting all these questions through now. I mean, I would say most of them are about pensions. So let's just talk about exactly what happened. So the change is, if you have pensions you haven't spent during your lifetime and you die, that is now in scope for inheritance tax from April 2027. Exactly. So let's just talk through how do we get, because as you say, this wasn't always the case. It's a window, this opportunity existed for 10 years or so.
Yes, that's right. And it's only pension pots, if you like. It's what they call DC, defined contribution pensions, money you've saved up in a personal pension, a SIP, something like that. That's really where it bites. So there are slight complexities with pensions that you're paid from your employer, but that's mainly where it bites. And as I understand it, Chris will correct me, I'm sure, the way it will work is that you will be allocated your threshold for inheritance tax, which is normally 325,000, though it can be more if you've got a house. It can be more if you're the second to die in a married couple. And that will then be allocated between your assets. So all the assets currently in scope will have some of that threshold, and then your pension pot will have another bit of that threshold in proportion to their sizes. And then inheritance tax will be charged on your pension above that bit of the threshold that's been allocated at 40%. And that will be taken from the pension fund, or indeed, it will be passed by the pension fund straight to HMRC. So you won't see it. The difficulty you might have is working out where all this money is and making sure they all act in a timely manner. And then the rest of your estate will be taxed at 40% above whatever remains of the threshold. So it's quite a complicated calculation.
You have to go off away and find all your pots of money so you can settle the HG
yes,
bill to
and
get
certainly
probate.
Former Pensions Minister Sir Steve Webb says that will be a bureaucratic nightmare in his words, though HMRC told me they didn't think it would be. They're going to sort all that out. So, it's a new thing, it is complicated, and overall it does mean that a pension pot you've saved up and not spent before you die, which of course is what the pension is there for, will be taxed when you pass it to your relatives, except your spouse. The spousal exemption will continue. So if you nominate your spouse to get your whole pension fund and you predecease your spouse, then there will be no inheritance tax. Though if you're over 75, there's income tax when you take it out. So that's what people are calling double taxation.
Yeah, the main change with that one, Paul, is the spousal exemption is very valuable, and it acts as a tax deferral. So when the surviving spouse is now faced with the similar problem of currently can pass those death benefits onto my beneficiaries, and it would be outside my estate for inheritance tax purposes. Now they've got this dilemma, well, if I die beyond April 27, my beneficiaries are now going to be, or the pension plan itself is now going to have a IHT tax charge. So the executors will have to rally round, as they usually do, value all the assets, and then there'll be a communication between the executors and the pension fund trustees to say, you've now got this taxable pot, this is the amount that you need to settle to clear the IHT on this estate. Unmarried couples, I'm a little bit worried about them because they had the use of an IHT planning tool to be able to say, I don't need to worry about inheritance tax on my pension plan. I want to leave it to my children, or they might be single parents. I've got the relief of the IHT exemptions to pass it on to my children. Now they're facing a real inheritance tax liability of potentially 40% on the value of what they've saved.
Yes, and single people do have a rough deal with inheritance tax because they have this £325,000 threshold, whereas if you're the second to die in a couple, you have
double the amount,
double 650. And if you're a single person without children and you can't leave your house to your children, you want to leave it to nephews or nieces or whatever, you don't get the extra threshold for the main residence. So single people without children are discriminated against in the system. And this will make it worse in a sense because they won't have this extra pot of money they could leave anyway, sort of outside the inheritance tax threshold. So that will be made worse in a sense by this change. change, I think.
Okay, before we move on, can we just clarify exactly what type of pensions we're talking about that will be caught here? So you said, Paul, that we're talking about defined contribution pensions.
Pension pots, as I call them, a SIP, a self-invested personal pension. Anything you've saved up, you put money into it, maybe your employer puts money into it, you own the pot, not a company pension where it pays you a guaranteed sum every year related to your salary. But there's something about death benefits that you understand better than me.
So I believe defined benefits and defined salary schemes from April 27 will be caught by these provisions. So they'll need to value what your death benefits are. It's important and worth noting that even if anybody dies currently, if the death benefits that they have are not written in trust, there's always been an IHT exposure. So it's a word of warning to anybody before the April 26 or April 27 changes. Make sure you've written or you've done a nomination form for your death benefits so that if anything was to happen to you in the short term, they fall out of your estate for inheritance tax purposes. We then move forward to the new changes in April 27 and that protection is removed, but there's still a period of time whereby if anything happens to any of your loved ones in the short term, and it brings us on to a bit of a moral dilemma question, because some people are planning or making end-of-life plans as we currently sit. And we're going to march towards, with the BPR changes and the pension changes, a significant cliff edge. Anybody who's in the terrible decision of having, I've got terminal cancer or I've got a terminal illness, and my likelihood with the next 18 months is not good, my prognosis is not good. But if my passing is the wrong side of April, I could have a very significant IHT liability, which I know you can't deal with everybody, but it's quite unfair, this cliff edge.
So you want to live as long as possible, but
you want to live as long as possible, but it's
over that barrier. You will
exactly.
Your family will pay a lot more tax.
So wonderful. I'm here for another year, but actually, it's cost me.
And the way it's been brought in is it is a cliff edge. It's just either side of that line.
There's no kind of tape.
There's nothing you can do about that.
Nothing that offers some kind of relief.
Okay, and there's a question here we should answer on this stage, I think. Someone asking whether the changes also apply to SSASs, which I think stand for Small Self-Administered Pension Schemes.
Yes, so a SAS, just for the benefit of all of us, is it's an employer-sponsored scheme. It's a fairly, not niche, but unique scheme. You or I, we can set up a SAF, a personal pension plan, but to set up a personal pension or a SIP, but to set up a SAS, it requires an employer. So we start a company, our employer, which is us, forms a SAS, and contributions flow into the SAS. SASs are quite beneficial in the way that they work and have a unique set of circumstances, and a lot of people have used SASs to hold investments or use it as an investment tool. And you can pass value within a SAS across the members much more easily than within a personal pension. Personal pension is unique to you, a SIP is unique to you, whereas a SAS and members, you can, in theory, if it's structured right, move value around. It's very specialist advice. You need to talk to a SAS specialist to talk about how you set one up and how you administer and operate it. And but it will be caught.
This comes back to what you said earlier, that this is like a wealth tax, isn't it? Because
exactly.
These are people who have a lot of money and complicated affairs in that case.
The value that you've allocated to an individual in that sense, that is what's going to be caught by the changes, because you'll need to put a value on this, whereas before it's just passed because of the BPR relief.
This is another kind of technical one, I think, Chris.
BPR, so pension relief.
Someone asking the same question in terms of what's in scope, but asking about CUROPS pensions. So I think these are overseas schemes.
So CUROPS is somebody's moved overseas and transferred their UK pension fund to an overseas registered pension fund. It's still registered with the UK here, but they are long-term residents abroad and decided to move their pension fund into an offshore pension fund. Now, I suppose it depends on what the profile of the UK residents is as to whether that would be caught. Again, it's very specialist advice.
You need to know a bit more, yes. I think, probably. Okay, let's move on to some other changes, because there were a few. Capital gains tax. Again, before the budget, there was lots of talk. Will the rates be aligned with income tax? We didn't quite get that, so there were no changes to capital gains on a residential property. But there was on shares and other assets, I think, held outside of ISAs and pensions. So for basic ratepayers, that's gone from 10% to 18% and 20 to 24% for higher ratepayers. Again, so that doesn't feel like it was as bad as people were predicting.
No, it equalises it with the capital gains on a second dwelling, and 20 and 24% is a great deal less than the tax rates for people, for people on their income. So I think it doesn't seem unreasonable to me. I mean, 20% is what you pay on your income. 24% is not higher rate tax, which is 40 or 45%. So I think it's quite modest. And as I said, I think earlier when Nigel Lawson introduced capital gains, he wanted them all taxed like income, but that was too much for the Chancellor. And I did read some very strong pieces saying this would be appalling and it would damage business. I don't know your view on that, Chris.
The last time we had a split year like this was Nigel Lawson introduced this, I believe, in '99. It could be earlier than that.
1988.
Thank you very much, Paul. 1988. And so we're going to have a new unique set of rules whereby gains realised up to 30th of October, one set of rates, and then gains post 30th of October will have a different set of rates, and then depending on where losses fall.
So two rates within the same tax year?
Two rates within the same tax year, which means if anybody doing tax returns for themselves, you're going to have to make sure you know what date you sold an asset and correctly record it. And losses that you might have realised pre or post, generally speaking, what's happened in the past is the losses get offset against the highest rate. So if you might have a loss from May of this year, the legislation is probably going to allow you to use that against the highest rates first before going to the lowest rates. So there'll be a measure of relief there.
And it's not halfway through the tax year either. You'll have to count the days either side of it, presumably.
You don't need to apportion it. You might be able to just say, well, I've got this loss
here.
Oh,
I see, right, yeah.
Can I offset against the gain that was in that time period? So a fairly straightforward, but
still seems quite knotty.
Some people have got share portfolios with 100 shares and are quite active, so you're going to need to go through that report quite carefully. So all the wealth managers and the investment houses are going to have to make sure that their reports are cut for pre and post.
And in terms of the advice, what people can do if they think they're going to be caught there, I mean, it's the usual, stick everything into an ISA or a pension if you can, if that's possible.
ISAs are still valuable. We haven't. The fiscal drag has meant that 20,000 allowance has stayed for some time, but make use of your ISAs to shelter income and gains.
And she did say she'd keep it frozen for a few years yet. So I think the 20,000 is it, and the other two lower rates.
We had a question here actually, Nick asking, "Are ISAs safe?" I'm using ISAs. Are they still safe?
I think they are. We need to encourage people to save and have less reliance on the state pension. So it's not the most incentive budget, I have to say. This budget was very much focused on individuals. It's not an aspirational budget to say, look, if you work hard and generate value, we won't tax you, because we'll tax you during your lifetime. We'll tax you if you generated too much value. I'd like to think that the ISA allowance would stay.
But there were suggestions before the budget that they might cap it, because if somebody has got £1 million in an ISA, that's not what it was for. It was to encourage people, as you said, to save a bit more. But if you've managed to have £1 million in there, none of it paying tax on the interest or the dividends earned, that seems to some people something that you could well put a cap on and say, OK, £1 million is it. But in a way, that would involve retrospective legislation, or at least a retrospective tax, because you'd have to say, well, you built this up over the years. And of course, if you just do it for the future, you don't raise any tax for another 10 or 20
if you
years.
Did that, it really would be a wealth tax if you did that.
Yeah, well, it would. Yes, it really would. So I would, predicting the future, as is it Feynman, the quantum physicist, said, prediction is very difficult, especially about the future, and I think it's very hard to know if they're always safe, but I would say they were safe. I mean, I'm happy with money I've got in an ISA. I don't think it'll be attacked.
Paul, you and I remember PEPs and TESAs, and now ISAs has been around for quite some time. So
yes,
we've had various iterations of saving schemes to encourage people to save and not be subject to income tax and capital gains. And also remember, the capital gains allowance has come down from £12,000 to £3,000. So although the 18 and 24% rates, you might as well ignore the £3,000. So I think the rates they're high enough.
Yes, and I should add that don't forget that big rise in capital gains tax, because the allowance came down, was a conservative measure. Yeah. And what Rachel Reeves is doing with the Labour government is actually not going to raise as much money from the figures I saw as that initial change in that tax-free allowance on capital gains. So, people are very critical of Rachel Reeves, and I can understand that if it's affecting you, but she was the first woman. She wasn't the first Chancellor to stand up and raise taxes.
I think the Tories gave her a lot of ideas on tax raising, didn't they?
Maybe they did, yeah.
Here's another one, which again, this was a kind of the direction of travel, I think, for the Conservatives. Stamp duty on second home, so that's for landlords or people buying holiday homes. And again, that feels like that was the direction of travel. They've been squeezed for a long time, I think, probably since Osborne was Chancellor. Is Labour trying to kill off the landlord?
I'm not surprised by the stamp duty changes. One word of caution for anybody who's exchanged but perhaps not completed. So they may have exchanged before budget day. You've signed your contract, you haven't completed. And invariably when you're in that process, you might be going backwards, forwards on negotiations. But if you change that contract for whatever reason, speak to your conveyancing lawyer, because any change in the contract is likely to subject you to a higher rate of stamp duty. Don't feel that you've locked in the lower stamp duty rate. Even if you're asking to pay for garden equipment or other, that variation of the contract will subject you to a new rate of stamp duty. Buy-to-lets, a lot of investors use companies to acquire buy-to-let properties. They have a high rate of stamp duty. It will make people think about whether a property worth 500,000 to $1 million is worth holding it in a limited company, because as you finance the project to acquire the buy-to-let into the limited company, you have high rates of stamp duty on the way in. Okay, you get full relief for interest costs, and the corporation tax rate is less than income tax. But if you sell the property, you want to extract the funds, you either have to dividend the proceeds out, or you have to collapse the company down and make a capital distribution. So with the increased stamp duty, CT, interest costs, and a few other factors, you begin to sort of work out, is it really sensible to hold a buy-to-let in a company? And I would say probably no. You have to have a very valuable property to make it worthwhile.
It's worth adding that the stamp duty changes affect England and Northern Ireland, but not Scotland and Wales, because they have their own systems. And the extra stamp duty for people buying a second or an extra home was introduced in 2016 by George Osborne, 2016, and now that it's been added to by Rachel Reeves, so it will be an extra 5% rather than extra 3% on the normal rates. That brings it up to roughly what it is in Scotland and Wales from my looking at the figures earlier today. So it is a lot. I mean, if you buy a very expensive one, you're going to be paying 17%, I think,
yes,
or something like that. So it really is a big chunk if you're buying a second home.
And anybody who owns property personally, even if you're moving the property into a company, you're still subject to stamp duty on the transfer of that property. And also, you have to value the property and on the value that you're transferring to the company, and you may realise a gain. So proceed with care if you suddenly think, oh great, I'm going to jump to a limited company because that will be better for me long term.
Yeah, but I mean that sort of move happens because over the years, recent years, and again under Conservative governments, buy-to-let landlords have been penalised. The tax breaks they have had, which made buy-to-let a very good way of having a bit of money in retirement at one time, bit by bit, those tax advantages have been taken away. And this, if you're buying a house, I mean, this is only about when you buy the property in the first place, then this is yet another blow to them, I think, or a blow to people who want to buy a second home, or a buy-to-let landlord who wants to expand and buy another property.
So you wouldn't be advising anyone if someone said, I've got a bit of cash, haven't got much for a pension.
But being a landlord is hard work. I mean, people think, oh, it's dead easy, money will just pours in. It doesn't, it's hard work. If you're going to be a landlord, take it seriously. Yes, it's fine if you want to do that, but is that how you want to spend your retirement, rushing around properties, sorting out leaky drains?
And Paul's comments, probably this is what the government's thinking. We want professional landlords. We don't want amateurs doing this. So if you're going in to become a landlord, then you've got to be aware of all the compliance and regulation around being a landlord and making sure it works and you're reporting this properly.
I'm sure they also like a bit of extra cash if they get any extra tax.
I think most people, if your loan to value is anything above 40 or 45% and you're on a repayment mortgage, you're probably not making money. you're probably just about break even.
But doesn't this break the cardinal rule? You don't borrow to invest. And, you know, people who have buy-to-let mortgages have borrowed to invest. Buy-to-let's probably fine if you can pay cash. Not many people can. But borrowing the money does leave you open to all these problems.
We wouldn't do that to build a share portfolio. You know, you'd save over time.
That's right. That's absolutely right.
Staying on stamp duty, because there are other changes, aren't there, coming in April, and it's interesting. We were talking before we started this, weren't we? That doesn't seem to be much for first-time buyers or people who haven't bought any property yet. The rate effectively jumps up with the threshold changing in April. And there's a question here, actually, someone asking about, my son turns 18 next year. Are lifetime ISAs still worth opening? That's one of these ISAs that's sort of for first property purchase, isn't it? It was interesting. There wouldn't seem to be much there for young people.
I think lifetime ISAs are very good if you stick to the rules. The problem with lifetime ISAs is that some people need the money and take them out, and they end up paying a penalty for doing that. But if you have a lifetime ISA, you can only use it as a first-time buyer to buy a home within certain value limits, or when you reach, is it 55, I think?
Yes.
Or something like, I think it's 55. So it's part of your pension. If you take it out at any other time for any other purpose, then you pay this penalty. Not only does all the extra the government's given you taken back, but an extra bit on top is taken back. So they are a very good deal. And if you look at the figures, some people really have used them to save for that deposit and buy their first home. Not against them at all, but do keep to the rules and make sure you will be able to. And of course, we never know, you know, whether it's going to be a relationship breakdown or illness or whatever, that you just may need that money in the future.
Okay, another change, well, the biggest one in terms of revenue raising was the increase in the national insurance that employers pay. Now, we were told, weren't we, repeatedly, that working people weren't going to be paying any more. Did she keep to her word? Because it feels to me like eventually we will have to pay.
If you're in the hospitality industry or retail and you're doing part-time hours or 0 hours contract, your employer is probably going to be feeling the pain, because if at that level, it's with the threshold coming down and the extra increase in the employer's national, so that's quite hard for businesses to bear, and they can't easily pass that cost on to their customers because it's a very competitive environment. If you're in financial services or professional services, you're probably now looking at that cost and thinking, well, we could pass that on, and maybe it equates to £1 per hour of chargeable hours for us. We can easily pass that on. But hospitality and retail, I think that's hard. It's a bottom line cost.
I think particularly hospitality. I mean, there is an extra allowance you can deduct, £10,500, I think, from the national insurance bill, and that now applies to everybody, not just smaller businesses. So that mitigates it. And in fact, I was looking at the figures, and if you've got sort of a handful of employees, you may end up actually paying less employers' national insurance. But once it goes above 4, 5 or 6, depending what your average pay is, then you are paying more, and a lot more. And if you look at big firms, you know, like Sainsbury's, Marks and Spencer's, Barclays Bank, they will be paying a great deal more in national insurance. What will they do with that? Well, economists, I think it was the Institute for Fiscal Studies, said they reckoned about 74% of that extra tax will in fact feed through into the economy in higher prices or lower wages. So in that sense, we will all begin to pay a lot of it, though it's not a direct tax. And I think on the very strict wording of what the Labour Party said, she probably did keep to it. But I noticed a subtle change of words from working people won't feel any extra tax. It was working people won't feel any extra tax in their pay slips. And I think
at least not overnight, but they will.
That's
eventually.
right, because their national insurance and their income tax and of course their VAT are not going up. But I think she probably just about made it. And I think she did say she was sorry for saying she wouldn't be putting taxes up at one point, which was a very foolish thing for a proto-chancellor to say this before the election.
The only thing on the employer's national insurance increase is anybody considering incorporation or staying as a partnership, because if you're operating as a partnership and the partners are not subject to, because they're self-employed, they're not subject to that employer's national insurance. So if they incorporate and they now become employees, they're now subject to a much higher level of stamp duty than they're previously modelling. So
the national insurance?
For national insurance purposes. So they might be thinking, well, we were considering incorporation, but actually we might hold off now for 4 or 5 years. Let's see what happens to this current government. Or they'll just say there are other reasons why we might want to incorporate, because we want to share equity, the share schemes that we want to introduce. There's still a good compelling reason for them doing so, but it's probably made partnerships which have a little bit fallen out of love more popular, or a consideration.
Okay, I'm going to rattle through a few more things that were announced, because we're halfway through now, I think, and we've got so many questions that we need to get to. Pensions, unsurprisingly, the main one. There was lots of chat around non-DOMs.
Yes.
Now, I know this isn't lots of people, but people are interested, I think, particularly if it means that people are going to start leaving the country, that we always read about. Is there capital flight going to happen? Chris, you're already quite close to this. Are you seeing people go, it's time to leave?
I think that those that were considering leaving have already left. So they were, with the announcement of realising that the Labour government was going to win and the non-DOM changes that were coming in, they've already been planning to move by April of this year. And the financial non-DOMs typically operating, and the high-profile non-DOMs are operating in financial services, private equity, hedge fund industries. They're very agile, so moving offshore is not a difficult decision for them. They've got multiple homes, they've got operations in Europe and other more favourable tax jurisdictions. So for them to move is quite straightforward. Whereas for you and I, it's to move our families, move lifestyles. That's a lot harder to do. So anybody who's been here long term and this is their home, they're probably staying.
It's the scale, though, isn't it? I'm sure there are a lot of people doing exactly what you say, but I can't remember the number. But it's tens of thousands of people are registered as non-DOMs, aren't they? And
and many more that don't realise they're actually non-DOM. They just don't access the rules.
Yes. So a few hundred, maybe even a few thousand moving doesn't really dent that figure. And of course, this, what you say, they moved by April this year. This was announced by the last government.
Yes.
I mean, I know Labour has changed it to a certain extent, but it was going to happen. We've known it was going to happen, and they've known it was going to happen. So I think it's the public perception of it, and I think from a perception point of view, it was the right thing to do. But yes, definitely, some people will undoubtedly leave.
Okay, and then a couple more things that, again, we sort of knew about, but they were confirmed. So the state pension, the triple lock, is confirmed for April 2025. So state pension on the new state pension, so post-2016, we'll be getting an extra £470 a year, which brings the full state pension, if you qualify, about £12,000 now. But a lot of those people will also be losing the winter fuel payment, and she doesn't seem to be going back on that.
No, there's no sign she's going back on that. And I must say there's going to be an important psychological moment in probably 2027 when the new state pension, which as you say is for younger pensioners, will exceed the personal tax allowance, because she's continuing with the freeze on that until 27, 28. Then it will rise slowly with inflation, but only with about 2% inflation then. And probably in 27, 28, the state pension will be slightly more than the personal tax allowance. Now, a lot of people have a state pension above the personal tax allowance because a lot of the old state pensions actually are quite big. But that will be a sort of psychological moment that, the pension they've fixed and the personal allowance they've fixed. So DWP will give you this new state pension and HMRC will want to take a bit of it back. And I think that will be a big moment, and she may have to edge it to do something about it at that time. But of course, she is just following the rules that the previous government set down until then. But even the little rise, she's planning 28.9, 29.30, which would be inflationary, with inflation on that 12,570. It won't be as much as the pension goes up. So I think it will get slightly bigger over the last 3 years of this Parliament.
Yeah, so even people who only have the state pension.
Yes, so just people who only have the state
wealthy
pension. And of course, HMRC is in the position it's got to start recovering what could be £15 tax over the whole year from, hundreds of thousands of people.
We're struggling to recover ULEZ charges, so to actually try and recover small amounts of it drives people mad, and it makes pensioners very stressful because they worry about these little things and how it's going to happen. It's such a shame. I know it's after the event that she just didn't say, look, the winter fuel allowance, the honeymoon period's over, I'm going to have to make it taxable. Would have been far easier. Keep it in place, and she probably would have got probably a third of it, 40% of it back.
Yes, it wouldn't have raised as much money.
It wouldn't have raised enough, but it just might have been a way of dealing with it.
And I think everybody would see that as fair. Whereas I think
it's
taking it away from that lower means test, there are a lot of pensioners just above the level where you can get pension credit who are undoubtedly poor and undoubtedly needed, especially if they have a disability that increases their heating costs. So I think the barrier is far too low. She could have got away with it much better if, as you say, she taxed it. Or maybe just taken it away from people, pensioners who paid higher rate tax, which would also have been
that would have been easy to
popular.
do, maybe.
But all these things require new systems, whereas she's locked into the old system, pension credit, and that means a lot of poorer pensioners will lose it. And I think
we deal with the high income benefit charge through self-assessment, so that it's clumsy and it's very annoying for people who suffer it. But we could have done something similar.
Yes, like child benefit, as you say, is
exactly.
removed. Well, that starts at 60,000 now, doesn't it? So it's a
I mean, she'll be hoping that it's not a cold winter, because we will start getting stories about people who are turning the heating off.
She certainly will be hoping that, yes. I think this one will run and run, though the steam has gone out of it a bit, though there is a court case coming up, I think, from one of the unions is seeking a judicial review in it. And I think there may be one in Scotland, because Scotland and Wales followed suit, so they say very reluctantly. But I think there may well be court cases. I think there's one in Scotland as well that maybe...
It does feel like a miscalculation in the way that it doesn't raise a huge amount of money, but it's sort of lost all this goodwill.
Yeah.
You would have thought. Let's get into questions, because we've got thousands coming through here.
We can stay on.
Some questions, some comments. That's why I do want to read this one first, because it's definitely not a question. I do not agree with Paul. Pensions are long term and this is robbery. So that's what you can respond to that if you like in a minute. But
well, I mean, it's clearly not robbery because that involves violence, but you may think it's theft. I just say it again. I mean, it's my very strongly held belief. You save up in a pension with huge tax advantages that cost the country 40 billion a year or something, to provide for your own retirement, not to provide wealth for your children. And I think that is such an important... That is what a pension is. It's not a way to pass wealth down the generations. It's become that, but as an idea, that is not what it is. And of course it will affect people. It'll affect me. Well, it won't. I'll be dead, but it will affect my children. I don't mind. It's fine by me.
And I think few people are thinking that, can I be certain that the state pension will be here for when I retire? So I can't bank on that. So if I save myself, I don't want to rely on anybody else. So my hard-earned cash, I'm saving in a pension fund. I'd like to have some protection.
But then spend it. Spend it while you can. Enjoy yourself. Go on cruises.
And I think long-term planning. If you talk to wealth managers, they now model people to living to the age of 100. So a few people are thinking in their 60s, well, what do I do? I would urge caution on making any radical changes, because if you're living to 100 and you're giving assets away to your children, at this stage, you've got potentially 35 years of your life left. And if you overgive, it's very difficult to get back, and you may underestimate what your requirements are. And Labour are here for 5 years. Be patient. Look at your wills and look at, well, what have I done with my death benefits? Okay, my pension death benefits, I've made a nomination form. Do I need to come back and look at my will? Because that's now referring to that, but it's operating independently. Letters of wishes. So talk to your lawyer about what do I need to revise my will to cope with the changes?
I think that is immensely important advice. I think everybody who's got a significant pension pot that they were hoping to leave bypass inheritance tax for their children. As I said earlier, if you leave it to your spouse, there's no inheritance tax.
But now the will is going to be complicated.
Yes, but wills, and of course you've got to have sort of dates in it. You have a nomination. Yes. If I die before the 6th of April 2027, I want this to happen. If I die after, I want that to happen. So it is going to be more complicated. I think people have to re-look at how they've provided for their heirs again. As they should every few years anyway, but this is a big change, and that is really important advice.
And in a similar vein, that there are business owners worried about passing on the value of their shares to their beneficiaries. And a way to perhaps protect any inheritance tax liabilities they're going to face beyond April 26 is maybe look at keyman insurance and life assurance as a way of protecting or funding the cost of the inheritance tax that the business can't otherwise afford. Keyman insurance, if paid by the business, as the proceeds come into the business, is treated as taxable profits. But if the shareholder is able to fund it themselves, write the insurance in trust so that the monies pay out to the beneficiary to enable them to fund the inheritance tax that they might have on the shares that they're inheriting. It's one way of easing the pain, because a lot of businesses don't have the liquidity. You're inheriting value in a business, you've got an IHT liability, and most of your value of what you've inherited is all wrapped up in the business. And the one thing you need is funds to be able to pay your inheritance tax.
Individuals can also take out insurance, can't they?
They can.
I mean, there'd have to be a lot of money involved, but it can be worthwhile.
An insurance policy that would just pay off
to
the bill.
pay the inheritance tax when it falls due.
It's expensive. It can be done, but
it is expensive, especially if you're older.
It may be something to consider.
Okay, now we have had a question here, which I assume is from a farmer. Should we just talk about the changes that were actually announced? We sort of briefly talked about them before, but Paul, changes to agricultural relief.
Yes, agricultural relief, broadly speaking, and I am no expert in it, but broadly speaking, if you left agricultural property, which is land and a house on it, or cottages that are related to the agricultural business, then they were 100% free of inheritance tax. That has only been the case since 1992-93, and before 1984 there was no relief, and it was 50%, and then it went put up to 100%. So that is being changed. The first £1 million, and that includes not just the agricultural property relief, but business property relief, which is a similar thing if you leave a business to your heirs. That was also 100%. Only the first $1 million of them combined will now be 100% relief from inheritance tax. Above that, they will be taxed at 50% of the inheritance tax rate, which means 20% tax. And that will be quite significant for a relatively small number, but for the people it affects, it will be significant.
And with farms, you have illiquid assets because your assets are the land. So the main farmer, the head of the household, dies, passes their farm to the beneficiaries, and they're faced with the prospect of, well, we want to carry on farming, but the only way we don't have access to £200,000 of readily available cash to fund the IHT liability. I'm plucking a figure out for you. So they've got to consider land sales or raising finance, which is very tricky. And again, it comes back to the timing of somebody's death, because if you die on the wrong side of April, you've got an IHT liability. But a 1 million cap on APR and BPR assets, and some farms are in companies, so that's another dynamic. 1 million cap, so that's roughly, if land values are 11,000 per acre, that's a 90-acre farm. There's a few TV programs around telling you how many acres you need, but generally speaking, to make a farm viable, you need 600 acres to generate probably 100,000 profit. There are a lot of farms in that category, and they are struggling to finance farms and make it work. But a 100-acre farm, they don't have the ability to pay anything over £1 million of asset value.
Well, the question here is, what advice for a small farmer whose son wants to carry on, but selling the land to fund the tax charge makes it non-viable? What should I do?
So they could, and we want to inspire and we want to incentivise the next generation to carry on farming. We don't want to face, again, a bit of a cliff edge where they say, we've got to stop farming, because if I pass this farm to you or leave it to you in my estate, we're going to have to sell up. So one thing they would need to value the farm and think, well, if I transfer this land to you now, and it's a business asset, I need to survive 7 years for this to fall outside of my estate for inheritance tax purposes. Eat well and drink well, as I say. And hopefully in 8 years' time, grandparent or parent has survived. The son or the daughter is now taking the farm on, and they're free. It's free from inheritance tax. That might be one way.
You've got to be careful of what are called gifts with reservation of benefit, haven't you? Because if you give something to somebody, but you keep the benefit of it, like if you give your son your house but you still live in it, then it counts as part of your estate. So with a farm, that would be a bit complicated.
It'd be complicated. You might give the land but not the house.
Yes.
And so, obviously the son or the daughter would need to carry on farming. It makes succession planning tricky.
But I should also add that the £1 million is on top of any other threshold. So, there's the 325,000 we mentioned. If you've got a house involved, then you can add 175, so that's 500,000. And if you're the second to die in the couple, so, dad dies, mum retains ownership of the farm, and then she dies, there'll be another £1 million there. So you may be talking of 2 million.
A bit higher.
And if you look at the figures for 21-22, which the government has produced, I think 462 claims for agricultural property relief were above £1 million, and 117 were above 2.5 million. So yes, that's quite a lot, but it's nothing like the 17 or 1800 farms that claimed it. Most of them would fall below the limit, and the government likes to talk about that. And of course, the people who are above it are the ones who say, good grief, this is going to be really difficult for me and my heirs. And I think it will affect some people badly.
And if this question is from a farmer that's operating in a company, you're actually just passing the shares across in the company. So if you don't pass the shares across in the company and the main shareholder dies, the company's to be able to fund the inheritance tax on the value of the shares passing, it's got to pay a dividend. That in itself requires, have we got sufficient reserves within the company to do that? It's not easy. Again, to get liquidity out of the company to pay a liability that they weren't expecting, and they probably haven't saved up for over the last 10 years.
We've mentioned a few times actually business property relief. We haven't spoken about the AIM share exemption. So some people invest in shares listed on the AIM market that qualify currently, or did qualify for exemption from inheritance tax. That's not the case anymore. What should people do if they have those shares?
Holding AIM listed shares was an investment strategy, or an IHT strategy to an extent. Qualifying conditions, you have to own the shares for 2 years, and assuming you on the day you die, you have held the shares for 2 years, you can pass them to your beneficiaries free of IHT. There's no cap on those AIM listed shares now, so the value passing is subject to tax at 20%. But also included in that group of share class will be EIS and SEIS shares, which won't have a cap. So there are many people who have made EIS investments and now subject to inheritance tax.
I think it's true, isn't it, that they made those investments to avoid inheritance tax. I mean, these are all investments are risky. These are particularly risky in most cases.
They're quite a volatile
So you might lose your money anyway,
yes,
regardless of the tax.
Yes.
But these are marketed as ways to avoid inheritance tax on a large part of your wealth. So you bung it into AIM shares or...
But typically anybody who's got an allocation of AIM shares will have maybe less than 5% of their wealth wrapped up in AIM stocks.
Yeah. So it's wealth tax, as we were talking about earlier.
Yes.
Okay, now we're going to go back to pensions. We've got a question here. I'm not sure the figure's quite right, but it's asking whether a death super tax of 87% is justified. We don't think it is 87%, do we? But let's just go through the numbers. So we think where these numbers maybe come from is there's now a 40% inheritance tax charge on unspent pensions. You also will pay income tax. The recipient will pay income tax at their marginal rate. So let's go through the example.
87. Well, the actual figures are if you pay 40% on the pension, as I said, on the balance above the allocated bit of the threshold, so that disappears. So then you pay income tax when you draw it out, your heirs do, on the rest, and that income is taxed at their marginal rate if you died age 75 or more. And so their marginal rate of tax, which might be 20% basic rate or 40% or 45% additional rate, is taken off a smaller amount. So if you work out the effective tax rate on that pension pot, it's 52% if you're a basic rate taxpayer, it's 64% if you're a higher rate taxpayer, and 67% if you're an additional rate taxpayer. In other words, your income is over £127,000. So it never gets to 87%, even if you're
it's much more than 40%. But some people might have
it is much more. But of course, it's taxed now. It's just not. It doesn't have that 40%. And the other thing I should say, and I've said it probably 3 times now, it's really important to remember, the 40% inheritance tax on a pension fund doesn't apply if you leave it to your spouse. So they will pay just the income tax on the withdrawals. And I should also add that the lump sum, the tax-free lump sum, if you haven't taken that out and used it, your heirs can't take it out and use it. Nothing is tax-free, it's all taxed.
We should talk about that, because there has been a few questions on sort of strategies, I suppose. So lots of people, it's okay, they might not put any more money into their pension to avoid inheritance tax because it doesn't work anymore, but there's already a load of money there. What should they be doing then? Paul's saying sort of you should be taking the tax-free element while you can?
Well, but if you take it out and put it in the bank, it'll still be liable to 40% tax if your estate hits inheritance tax. So that doesn't really work. You can take it out and give it to your heirs a bit at a time, or hope to live 7 years and give them a bit more. But then you're giving them what should be there for you, and if you really don't need it, then that might work.
The only way, Paul, I could see that working is there's a valuable relief that's still available, which is the gifts out of income.
Yes.
So anybody earning, for example, 100,000 a year, pays tax of 40 from ease of maths, has 60,000 of income, net income. They've worked out how much they need to fund their lifestyle, and that's 40, so they've got 20 of surplus income. They can give that 20 of surplus income away to their beneficiaries without having to worry about the 7-year charge, the £3,000 annual allowance. So it's a very valuable relief. So if we then factor in accessing your pension, the tax-free pension sum, I'm thinking, well, okay, so if I've got £1 million pension fund, I'll draw down 250. I've now got a pot of cash that I can use to access. So maybe my surplus income is higher. So I don't need to access my surplus income. I can give 60 away because I've got this pot of cash. So you are, over time, reducing the value of your estate.
And you could use that cash to buy an annuity, which is an income for life from a lump sum. And you'd say, oh, I bought this annuity, it gives me £2,000 a year, or £10,000 a year. Oh gosh, I don't need this £10,000, and then you gift it to your children because it's surplus income. I mean, I can see those kind of things working, but I can also see HMRC looking very carefully at what you do to make sure. And they
have to prove that it's excess.
You have to prove it's excess. It has to be regular. And I did ask HMRC today, what about if I take out an annuity with a guaranteed life? Because sometimes you can take an annuity that will last for 25 years, whether you die or not. And they do not know if that is going to count, how they are going to deal with that, because, of course, that is a way of bypassing the rule. But I think your view, Chris, explained to me earlier, was that
yes,
it would actually work. Or
I think it might work, because an annuity is a right to an income over a period of time. And that might be whole of life, and your survivor gets it for their whole of life, rather than others are for a defined period of time. But to me, it's not an asset. And if it is an asset, that enduring benefit diminishes over time. So if at the point when somebody dies, there's a right to an income passing to a beneficiary, I would say that's the only bit that you tax is the income that's been received and the cash that you've received but haven't spent. But the ongoing income stream isn't a value that I would tax for IHT purposes.
We don't know yet, though.
I don't know, but that's my educated guess.
Yes, and it makes sense.
So they might confirm to you at
some
point.
The note of caution, HMRC told me, guidance will be issued in good time before April 2027. So don't do anything rash now. Wait for the guidance. Make your decision then with a financial advisor or a professional accountant.
Yes, I think a lot of wealth managers, pension advisors will be running around now for the next 18 months thinking, okay, what strategies, what rules, what legislation do we need to be aware of?
Someone's asked here a question, I mean, this while we're on it. Is it possible to transfer part of a pension just directly to your children?
No. Currently, in your lifetime.
In your lifetime, and if you haven't touched it.
A personal pension or a SIP, it's unique to you. The SAS that I mentioned earlier, that's the only scheme from memory that enables you to transfer value within the umbrella of this SAS structure. But personal pensions, it attaches to you, and it's the death benefits that you pass.
Okay. A few questions as well around trusts. Is there any sort of help you can get there by using trust to...
We're both looking at each other. I mean, my general view of trusts for the vast majority of people is they are expensive and not worthwhile. If you're the Duke of Westminster, I don't think he paid much inheritance tax because all his property that is sort of his is actually held by a trust. And it's the same for all the very, very big estates in the country. But I think if you're an ordinary sort of person and you're quite well off, but you've got £500,000 in a pension fund and you maybe a house worth £900,000, there's not really... trusts are expensive. You have to pay tax when you put it into trust, don't you, Chris? And
potentially, if it's over your lifetime, nil rate band.
Yeah.
I still think trusts have a use. We give advice based on what's the purpose behind why you're doing tax planning rather than just saving tax? So that it may be a protective measure. It may be I need to put this asset in a trust because ultimately the beneficiaries of my estate, they don't have the maturity or they're too young to be able to...
Or they're unwell sometimes.
Or exactly, they might
that
be disability trusts or there's been an insurance payer. Trusts are very valuable in that for those reasons. So again, I would recommend caution with anybody just jumping because of a number of tax changes, which in 5 years' time may or may not still be here.
Or maybe worse, of course, we don't know.
Or they get worse, yes.
Because there's the cost of setting up a trust,
yes.
Literally paying someone to do it, and then there's tax charges on the way. So it's not as simple as just bung it in there.
And you still see them adverts from companies, and they get people into hotels and meetings of older people, and they sell them something for several £1,000s, put your house in trust, protect it from inheritance tax, and even they say, though it would never work, from care home fee means tests. And then I've come across cases where the company's gone bust or out of business. People have tried to get the heirs, the person dies, the heirs then try to get the property. It's in trust, you have to deal with trustees that may have disappeared, you can't find them, and it's very hard to get that property out. It's going to cost you more money. So it will actually cost you more money rather than save you money. Very, very dangerous to do that unless you're very, very well advised and you have a significant amount of money.
Paul, you and I have been around long enough to know something that was well conceived, well thought out 20 or 30 years ago is now, and through no fault of anybody's, that you're beginning to look at, has the trust that I've got served its purpose? And should I now begin to exit from this trust arrangement? It's not tax motivated, it's just it has served its purpose, the beneficiary of an aid, let's start appointing capital out. But I certainly wouldn't shy away from the use of trust going forward. It's just, what is the reason you need a trust?
And so it shouldn't purely
think
be
about,
for
exactly, and think about the tax consequences afterwards.
Yeah, but if it's purely about tax avoidance, it's probably not a good idea. But if you need it for some other reason, they do have a very valuable position in society for some people in some circumstances.
Okay, now look, we haven't got a huge amount of time left, but I think we should spend a little bit of time looking forward. So this is Victoria's first budget. There's going to be a few more. One of the questions was, are pension lump sums safe? What could next be in her sights? Does anyone want to hazard a wild prediction?
Well, I would hope she will look at the tax on pensions when you put money in. Because at the moment, the people who get the biggest incentive are the richest. And that's why we have all this talk about big pension funds that people don't actually need in retirement.
You're talking about tax relief?
Yeah, I'm talking about tax relief on the way in. And I think, the people who should be saving more in pensions are people who pay basic rate tax. They get the lowest subsidy. If that was raised and the subsidy for people who pay higher rate tax was reduced, and there's been many people suggesting this, it's certainly not my original idea, that would act as an incentive for people on lower incomes to put more into pensions and a disincentive for people on higher incomes to bung as much as they could in. And I think that would be a very positive thing for society in the long term. But it's incredibly difficult, and everyone I talk to about it in the pensions industry says, it's all very well with pension pots, but if you're talking about salary-related pensions, it's very difficult.
We do want some incentive for people to save, don't we? You want people to lock up money and pay for themselves.
But you would get an incentive. You'd have, say, 30% rather than 40% incentive to save.
Yes, so, don't rely on the government.
Yes. Well, there's also that. Yes,
do you think that she would do that, something like that?
I don't know. I've not seen any hint she's thinking of it, but I think there is a lot of people who think she should be doing that. I would have thought lump sums were much more difficult to do anything with, because that would really smack of retrospective taxation, because you've built them up expecting, I know people will say this about expecting not to pay inheritance tax on them, but you build them up expecting to be able to take 25% tax-free. And if that was restricted, it's already been restricted to £273,000 or whatever it is. Then I think if they reduce that further, I think that would be difficult. But it may happen, and I'm not sure how much it would save in the short term either. I mean, you've got to think chancellors want to raise money this year. They don't want another chancellor in 10 years' time to think, oh, great, I've got a lot of money coming in from what Rachel Reeves did 10 years ago. They want to get it now.
I think the rumours that were in the market about CGT rate increases, most people had positioned to crystallised gains before budget day. So there's been a rush to the sales thinking, okay, there are sales on the CGT, let's do transactions now. So hopefully, looking forward, you might think, okay, we've got an uplift in the tax takings in a year or 2 years' time, more than we'd considered. So it will hopefully dissuade her from doing any further significant changes and thinking, okay, the deficit's looking good, this black hole isn't as big as we thought it might be, and we're making inroads. I think if there's enough traction, she might be dissuaded from touching pensions or doing changes on pensions.
Okay. And what about, I mean, none of you predicted tax cuts under this government. I think they've talked about the personal allowance being unfrozen or some of the thresholds being unfrozen in the future, or they've at least not said they're going to be frozen.
No, she said they will be unfrozen from 2028, 29.
Right, so you'll get an effective tax cut.
They'll rise with inflation. Well, you won't, because it rises with inflation, so it stays the same. I mean, what we've had, it will cost £40 billion from taxpayers by the time the freeze ends, because from the extra tax we've all paid. Tax cuts, I think the 20% rate of income tax is pretty sacred, though of course in Scotland they have different rates. They do have a 19% rate there for a small amount of income. I think that's pretty sacrosanct. Labour has very much criticised the previous government for cutting national insurance from 12 to 10 to 8% as it did, so I don't see them cutting that. So I think the taxes that they have said won't go up, like VAT, income tax, national insurance, probably won't go down either. Other things they might fiddle with to try and encourage investment, but I can't predict.
The only other thing I could think of that she might do, rather than touching rates, is the 100,000 allowance, or the 100,000 threshold rather, where we test for the loss of personal allowance. She could bring that down to 90. That's not a rate adjustment, but that would be very painful. So easily that could be moved.
Just explain why that's an issue at the moment then.
So at the moment, if your taxable income creeps above 100,000, your personal allowance, for every £2 you go over that limit, you lose a £1 of your personal allowance. To such an extent, when you get to about 122,000, you lose all of your personal allowance, and it creates an effective rate of 60% tax. It's very harsh, and most people don't know that they're going to have to refund tax because they're in a pay-as-you-earn system. They get to the end of the year, got a bonus or other things in their personal investment character, means that they've tipped over, and all of a sudden they're having to write a cheque for probably £6,000 back to HMRC.
You're saying they could bring that sort of...
If they brought that down to 90,000, then you're accessing a far wider group of people, and that would increase their tax take. Yeah. Very harsh, and I think that would send people a few shockwaves.
It certainly would. I mean, it was suggested before the budget that it might happen, even down to 80,000, which of course is where the child benefit high income charge runs out. But it would be very harsh. You can avoid it, I should say, by putting more into a pension, because if you bung a lot into a pension, if you get a nice bonus and it takes you over that 100,000, put the whole bonus in a pension up to 60,000, and that will bring you down below it. So I know people have been doing that. Though if you're on PAYE, it's a bit fiddly to get it back, but you can get it back. So that would, to me, that would be an extraordinary move.
It would be extraordinary.
It's a possible one.
And if you're already funding increased mortgage costs, the Bank of England, I think, are meeting this month to look at rate
on Thursday
again. So most people are hoping for an element of relief. So if mortgage costs stay as they are, if Rachel did this in the next budget, and let's say the March budget, then potentially that would be very painful going forward.
But she has said she won't do any tax changes in the spring.
But it's not a rate change. It's messy. It's a bit like lowering the annual allowance for capital gains. You could make that zero. Well, I haven't done any tax changes. I've just taken the allowance away.
I thought it was clearer than that she will only do tax changes at the budget, which is going to be at this time of year in future.
I think Chris needs to don't give her any more
But
ideas.
we'll see. I mean, never say never with politicians and money.
Okay, well, we're going to have to come... We're out of time, I'm afraid, so we'll have to come back in a year's time and see if your predictions for sort of a tax rise and maybe some more pension tax relief fiddling around comes true. So I think the only thing left to say is thank you for watching. Thank you, Paul, and thank you, Chris.
Thank you very much.
Thanks very much.